Hi there, welcome to Kneppy Invest. Time for another technical update. Now, typically on a Saturday, I will look for companies that look interesting on their charts, but I want to focus on commodities in this episode. So we'll be looking at gold, iron ore, lithium, oil, those sort of things. Also looking at 30-year US bonds. Also looking at the XSO, which is the Australian small caps. And I will include one really interesting company on the ASX. And when I say interesting, I'm just talking about the chart. Now, I did have a quick look at the fundamentals of this company, and even the fundamentals look really interesting right now. I wouldn't say it's a high quality company, but the chart looks interesting. The growth in the company looks interesting over the past 10 years. It's been around for a long time, but the market is really interested in this company now. And it's actually hard to find companies that the market is interested in right now. Also hard to find companies where there is a well-defined uptrend. And this company has a well-defined uptrend, the perfect sort of chart you want to see if you are a shareholder. But first, I want to talk about gold because gold has gone through a pretty powerful support level in the past week. This is the gold weekly chart going back 2 years and 2 months, all the way back to June 2020. And gold has been trading in a range between about 2070 and 1680. And every single time the gold prices have got to the bottom of this range, 1680, we have seen some buying coming in. And we know there has been buying coming in because when you look at the weekly candlestick, we see long tails. Some of them not so long tails, but some fairly long tails. We saw a really long tail back in March 2021, also in August 2021. And most of the other times the gold prices have reached 1600, we have seen some sort of tail, which means buying again. But in the past week, gold prices have fallen through that support level, which is depicted by that horizontal dashed line. Now, this is just a weekly chart. And I had a look at the copper charts, and we had the same thing with copper a few months ago, and then we saw a lot of buying coming in the next week. So this is not confirmation. The support level has been broken. We would need gold prices to go back up above this support level for it not to be confirmation that it has broken. But this is a bearish or possible bearish sign moving forward for gold. And the other thing to point out here is every single time gold prices get to the top of this range, it's only been twice in the past 2 years, we see a lot of selling with those candlesticks, those weekly candlesticks, having a large tail to the upside. So at this point in time, a really interesting week for gold, and it has possibly fallen through the support level. And this is the daily chart for gold going back to September 2020. And the main thing here is looking at what's happened in the past few days. So, in fact, gold fell through that support level, that strong support level on the Thursday. A lot of fairly big movement in gold on that day, but we did see a little bit of buying coming in the next day. And actually, gold prices moved towards that support level, and then we saw a little bit of selling. So that was those people who saw a little bit of a bounce in the gold who decided to sell out of gold because of that little bit of a bounce. So very important to see what happens with gold over the next, say, week or so. And if we don't see a significant rally in gold, we might have seen a bearish signal when it comes to gold prices. Now to oil monthly, and this is, of course, the monthly chart going back to 2003. So even though oil has decreased 4 months in a row, yes, oil has decreased 4 months in a row from the top we saw back in April. Doesn't mean it is the end to the decreasing in oil, because we have seen twice in the past 20 years when oil has fallen for 7 months in a row. That was back in 2008 during the GFC, and also back in 2014 when oil fell from about $110 a barrel all the way down to $48 a barrel. And in fact, over the next few years, actually kept on falling to the low we saw during the COVID-19 financial panic. Now, if you look at where oil prices are in right now, they're not at the sort of the high side because they've been significantly higher in the past, particularly in late 2000 or early 2008. And we also saw oil being fairly high from a period between 2011 and 2015. Now, we have seen oil at the low side as well, going back to or the low over the last few years. But right now, if you look at where oil sits now, based off the last 20 years, you can't say it's too high or too low. Sort of somewhere in between, sort of the normal range of oil. But I wouldn't be surprised to see oil fall further from here, because back in 2008, last time we had a really significant worldwide recession, we saw oil for 7 months in a row before it turned around. And there is that potential the world is going to be moving in sort of a large, widespread recession. I think most countries, particularly in Europe, Western countries, will be moving into recession. I think that's the likelihood of that is increasing. So there is that potential that oil will keep on falling from here if that does happen. Onto coal monthly, and this is thermal coal monthly, Newcastle coal. This goes back to late 2008. Now, if you have been following coal and following the share prices of Whitehaven, what's the other one? New Hope, even some of the smaller coal companies, just like most other mining companies, the share price of those companies are beholden to what's been happening or what's happening to the underlying commodity. So when you see the commodity getting to an historically large high level, that's the time to sell. And when it gets to a historically low level, that's the time to buy, because it's cyclical. And that's definitely true for coal between the period of 2008 and the beginning of 2021. However, over the last year and a half, coal prices have absolutely skyrocketed. And have a look, maybe a bit of homework here, have a look at the share prices of New Hope, Whitehaven, Yancoal, that's another one. The share prices of those companies have simply gone bananas, and that's because of coal prices. Now, whenever I see prices of anything, no matter what it is, could be commodity prices or could be share prices of a company, when I see anything go higher or grow exponentially higher like we're seeing here with coal, that does make me a little bit wary. And even a lot of coal companies are trading right now on a fairly low P ratios. So the market is expecting eventually that coal prices will plummet. And that's going to happen eventually. Coal prices will plummet from where they are now at, say, $440 all the way down to as low as, say, $40. That's eventually going to happen. And that's one of the reasons I would not rush into coal right now, unless you really are going to be trading it. Now, that's just my opinion, simply because we don't know the future. Maybe coal prices will remain elevated like this, but if they do remain elevated like this, coal plants around the world will not be viable. Now onto lithium, and I've used trading economics for this chart. If you don't know what trading economics is, Google is your friend. I do highly recommend having an exploration moment or two going through what trading economics can provide you. I do use trading economics quite often for charts. They have lithium, cobalt, wheat, corn, potatoes, lumber, that sort of thing. So I highly recommend going through trading economics. Most of the other charts in this video I get straight from TradingView. Now, this is lithium prices going back, and lithium carbonate going back to the middle of 2017. The reason I go back that far back is because that's the last time we saw a peak in lithium towards the end of 2017, and then we saw lithium prices fall away for the next 3 years, and then lithium prices broke out in the beginning of 2021, and then we saw an exponential rise in lithium over the next, say, 18 months. But instead of lithium prices pulling back, like you do see a lot of times when any sort of price goes exponentially higher or rises exponentially higher, instead lithium prices just went sideways. So it's consolidating right now. So that's actually very healthy moving forward for lithium. And this is one of the reasons why I might be interested in buying into some lithium companies, particularly right now, because there is a potential breakout in lithium. So lithium prices right now are almost at the same level we saw the last time they peaked, which was about 6 months ago. And if they get through that recent high, 6-month high, that would be a bullish sign moving forward. Now, in the long term, I'm actually a little bit more bearish about lithium. 2 reasons why I'm bearish. First reason is for the viability of electric vehicles, lithium prices actually have to be low because of lithium batteries. We can't have lithium batteries being too expensive and lithium prices are too high, then lithium batteries will be too expensive, which means electric vehicles will be too expensive. The other reason I am long-term bearish about lithium is because the amount of lithium companies listing on all the exchanges around the world because of the rapid rise in lithium we've seen over the past 2 years. So all these companies, mining companies, probably 2 years ago had no intention of moving into lithium, but because of lithium prices, they're moving into lithium. Some other companies on the ASX have abandoned moving into gold or copper and are moving into lithium. So a lot of times, historically, when you see an explosion of companies moving into one commodity area, that is a sign that that commodity price is peaking. Now, I think there could be some really good tailwinds behind lithium over the next few years to keep the price of lithium moving forward. But if the price of lithium keeps on increasing, that means more and more companies will be moving into the area, trying to get into lithium production. And if more and more companies get into lithium production, that would put some pressure on lithium prices because it's all about supply and demand. And even if the demand keeps on increasing, the supply is going to beat that demand. And that's how you get pressure on lithium prices. And that will eventually lead to lithium prices falling. And that's actually good for the world at large because we actually want lithium prices to be quite low. Now on to iron ore. This is the Iron Ore Weekly, go back to 2011. And iron ore is something, or one commodity I do follow very closely because the biggest miners in Australia are iron ore, or predominantly iron ore miners, BHP, Rio Tinto, Fortescue. And have a look at BHP chart, or even Rio Tinto's chart, even Fortescue chart, back between 2011 and 2016. The time to buy BHP was in 2016, when iron ore prices were at their lowest. So again, for most mining companies, the best time to buy those companies are when the underlying commodity is at its lowest point, because all these companies are cyclical. And a lot of iron ore producing companies back in 2014 and 15 actually are no longer with us because they became bankrupt, which puts pressure on the supply. So there's going to be less supply moving forward, and eventually, because of the less supply or the lower supply, that's how iron ore prices started to climb. The other reason iron ore prices started to climb, particularly in 2000 or late 2018-19, was that Vale mining disaster, and that also put pressure on iron ore supply, and that was good news for Fortescue, Rio Tinto, and BHP, and eventually we saw iron ore prices get to a high of 220. Now, one of the reasons I'm following iron ore prices right now is we've seen a significant dip in iron ore over the past few months, and iron ore prices are just above $95. The last time we saw iron ore prices get down this low, about a year ago, or just over a year ago, it was towards the end of 2021, we saw a bit of a bounce. So right on, or just below $95 is a really strong support level. If iron ore prices fall below that level, that would be bearish moving forward for iron ore and iron ore companies. Now onto the XSO Daily, which is the small cap indice for the Australian market. And there's quite a few indices I do follow: the XJO, XAO, XSO for small caps, and that's just on the Australian exchanges or following Australian companies. Now, the reason I'm looking at XSO now is because there's some really interesting technical signals with the XSO. And the main technical signal is around support and resistance. So there was a support level at just above 3080, which is portrayed by this horizontal dashed orange line. The reason it was support going back to the start of this year is because the one time we saw the XSO hit that support level, we saw a nice little bounce. That was in January, and it remained above that support level up until the beginning of May. And then it fell through that support level on strength. A really big down day, fell through it, and then we saw a bounce. And then the XSO tested that support level, which has now become resistance about 3 times over the subsequent or the following 3 to 4 weeks. And then we saw another massive sell-off in June. And then we saw a nice little bounce. And, there was a lot of discussion whether this was the end of the bear market or just a bear market rally. But look at where the XSO reached a high during that bounce. It hit that resistance almost perfectly and now has fallen away. Now, the discouraging thing about the XSO is we have seen 3 pretty big down days two particularly, the Wednesday and the Friday, and the XSO has fallen through the previous low we saw a few weeks ago. Now, if the XSO falls below the low we saw in June, that would be a very bearish signal. So that level was about 2,620. So I think there is potential. We're going to test that level again because the overall negative sentiment in the markets right now, and also because of what's been happening in America and higher than expected CPI numbers, I think there's much more likely we're going to see interest rates keep on rising. And if interest rates keep on rising, there's a higher chance we're going to be moving into a recession. And even though some commentators will say there's very little correlation between the markets and the economy at large, that's absolutely false. You will see if company or countries move into recession, that's really going to affect equity markets around the world, and you will see significant sell-offs moving forward. Now, some of the sell-offs have already, I won't say come to a completion, but I'm starting to see some companies starting to maybe turn around. Particularly those companies have seen significant sell-offs in the past few years. So I'm talking about not only non-profitable tech companies, also some profitable tech companies, say PowerPow. That's actually, their chart looks really interesting, and this chart is starting to turn around. Sentiment is starting to turn. But the sort of companies I'm thinking we will see a significant sell-off over the next few months potentially are Apple, Microsoft, those bigger companies, because typically in a bear market, those are the last companies to have a significant sell-off. Now on to 30-year US bond yield monthly chart. This goes back to 1987, and this is the perfect chart you want to study to understand downtrends and uptrends. And when I say uptrends is because, don't forget, US or bond yields are inversely correlated to bond prices. So if you look at a bond price chart, it would be complete reverse to this, and that chart would be in an uptrend, a perfect looking uptrend. So why do I describe this as a perfect downtrend? Because you're looking at lower highs and lower lows consistently up until possibly right now. We have seen a significant rally in bond yields over the past, say, year and a half. They've increased from less than 1% to right now 3.5%. The last time we saw bond yields this high was actually, I was going to say back in 2018. Remember, late 2018, it was looking like bond prices were going to start rising, interest rates were going to start rising. Then all of a sudden, the Fed pivoted in early 2019. That's why you see bond yields falling rapidly from then. So that's the last time we saw bond yields this high. But it does look like recently in the past week or past month, bond yields have gone above that high we saw in late 2018, which means the next or last time we saw bond yields this high was back in 2014. So we're looking at an 8-year high when it comes to bond yields. So it does look like potentially this downtrend in bond yields has come to an end, just because of what's been happening in the past few months. Now onto the one company whose chart looks really interesting. Now there's quite a few charts or ASX company charts that look interesting right now, but I'm just focusing on Lindsay Australia because they released their full-year results and the share price absolutely took off. And it's understandable why, because this company is growing at a nice clip over the past 10 years or so. And it seems like now is the time the market has become interested in this company. Now, the PE ratio is still less than 10, I think, and the company has a dividend yield. It's a profitable company, and this company has continued to grow. So Lindsay Australia is one of those transport companies, and if you do drive a lot, you might see Lindsay transport trucks on the road. So this company, I think, has experienced some tailwinds over the past year in regards to transportation. And the question is whether those tailwinds can continue. And the market is excited that these tailwinds and thinks these tailwinds can continue just because the share price has rallied over the past 2 months. In fact, the share price has increased 50% in the last 2 months. And on the back of the release of their full-year results, the share price absolutely took off. In fact, the share price increased from 45 cents to a current share price of 64 cents. So even though there's overall negative sentiment and a lot of pressure on the overall market, there are some companies whose share price are still moving up and are still in an uptrend. And Lindsay Australia is one of those companies. I'm going to take a closer look at their full-year results because I think this is still a potential buy, particularly if we do see a pullback in the share price. And over the past year and a half or 2 years, we on occasion see Lindsay Australia share price pull back. In fact, we see it quite commonly. And share prices of all companies do not go up in a straight line. You'll always see pullbacks, and you might hear the term buy the dip. And this could be the sort of buy the dip situation, particularly if you have a look at their financial year results and it's a really good result and you do like the future of this company over the next 5 to 10 years. That's all I have for this technical update, looking at gold and a few other commodities, including iron ore and lithium, and also focusing on one Australian company whose share price is still in a well-defined uptrend, and there's a lot of positive sentiment around that company, Lindsay Australia. So maybe have a look at Lindsay Australia, have a look at their full year results, financial year 22 results, and see why the market might be really interested in that company right now. If you have any questions, any thoughts, any opinions, please leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.